investor that's just starting out in the market, what are some of the things that I should be looking at? What are some of the things that I should be doing in order to make my investment career a successful one?
The last thing you do is look at property.
Okay.
The very first thing you do is start picking a region that has a future, not a past. Not something that you heard somebody made some money with, not something that you think, but go and ask the tough questions. Is the population growing? Is the average income increasing? Because here's the formula. If you have GDP growth in your region that you're targeting, you will have job growth. And if you have job growth, people will move there. And if people move there, the rents go up because the vacancies go down. And if the vacancies go down, the rents go up. 18 months later, and this is how we are always right for the last 19 years, is we don't look at the housing stats. We don't really care what the housing stats are. That's the equivalent of driving across the city of Toronto staring just at your rear view mirror. Everything's behind you. I want to know what's coming 18 to 24 months from now. So look, GDP growth equals job growth, which equals population growth, which equals vacancies decreasing, rents increasing. Therefore, people 18 months later will start buying property. It is so simple. Don't tell anybody how simple it is. You'll take my job, but that's how it works. If that's how you analyze, pick that first, then become a geographic specialist. Know that neighborhood or know that city. Like if you're going to pick Barrie, for instance, or the Junction in Toronto or whatever it is, know that neighborhood better than anybody else. Know what everything would rent for. You know what streets are good, what streets are not good. Know it. Be a geographic specialist. Please don't buy one in Hamilton and one in the Junction and one in Barrie because you buy Ontario real estate. Yeah. That's a great way to go to bankrupt.
Okay. So what type of properties would you invest in if you were to start out? Would you consider somebody going into pre-construction, buying pre-construction, or would you be looking at? I know you talked about the location. We've talked about that. So is there a specific type of property you'd be
Absolutely.
looking at?
The specific type of property is one that cash flows and cash flows strongly. I don't want to be buying pre-construction because I don't know if they're going to build it to the specs that I want, despite what the plan says. I don't really know what the view is. I don't know anything about it. And inevitably, what I'm doing if I'm buying pre-construction is speculating. I'm hoping that I'm buying it cheap, and I'm hoping that it's going to go up. If I buy a property that exists now, it's 5 years old or older. A lot of my stuff is built in 1970s.
Yeah.
I can analyze that property. I know everything about it. And if it cash flows, it works. If it does not cash flow, it's pure speculation. You're only hoping that it's going to go up. So only buy cash flow if you're starting out. And you know what? You're going to kiss a lot of frogs before you find that princess or prince that's going to cash flow. But just be patient. It's not a race. Real estate's not a race.
So just be slow and steady, be persistent, and just keep on doing your analysis and seeing which areas. Now, one question I want to ask, we talked about the analysis. How do you find all that information, the GDP data, in a specific region?
Well, that's really interesting. You go to the economic development office of that city or that town, and then they will be able to provide you the city's information. And some of the cities are so good that they will break it down to regions or quadrants. They probably won't go down right to the neighborhoods, but quadrants. But if you can't get GDP numbers, start looking for job growth numbers and population growth numbers because they are an indicator of the GDP growth.
Okay.
And that's how you would look. And then what you do is you take that GDP of your town or the job growth of your town or your target region, compare that to the province and make sure it is ahead of the province's percentage growth, not behind. Because if it's behind, it's always going to be a laggard. And you can pick those kind of cities out all over the province, and you can get stuff cheap. And this is one thing: real estate that is cheap is not a good deal. Real estate that is undervalued in a region that is going to be growing in the next 24 months is a great deal. Big difference.
So the theme that I'm getting from here is instead of looking in the rearview mirror, look in front what's going to happen in the next 18 months.
That's right. Yeah. And it mitigates risks. It really shrinks your wasted time at looking at properties all over the place. And thirdly, you know what? Real estate's not supposed to be your life. Real estate's supposed to be an investment that empowers your life and gives you money to go do what you want to do.
Yeah.
And don't make it your life.
Okay. No, we're touching on timing over here, so I'm going to ask the question that everybody asks me. Is there a good time to buy or sell real estate?
Absolutely. There's always a good time to buy and sell real estate. And the only way to know that is to ignore real estate stats and to go back to, wow, is the population growing, yes or no? And if the population is growing, it's a great time to buy because inevitably that'll get pushed up. Other parts of the cycle will push it back and down and around. But over the long term, don't buy a piece of real estate unless you have a 5-year minimum window, because then the market will take care of any of the mistakes that you make. You won't get caught trying to time the market. This is not day trading.
Yeah.
This is buying hundreds of thousands of dollars worth of real estate. But here's the truth. You take a look at where else you're going to put your money to get a good return. If you do the math, you put 25% down and you do 30-year amortization mortgage. If you put 25% down, 30-year amortization mortgage, you rent that out with zero cash flow. That's not recommended, have positive cash flow, but zero cash flow. Your return on investment annually is 15.7% return on your money. Where else are you going to get that?
Banks give you 2 less than 2.
Well, you know, anywhere.
Yeah.
Take a look around for the lack of risk that you can get into that market. All you need is a tiny little bit of increase, and you get a home run. So very important. That includes the tiny increase and the tiny bit of mortgage pay down. Home run all day long. I will take 15.7% any day in any market because I know it's not a race.
Yeah. So one question that will come up when you're looking at investing in real estate is, how do you raise money for it? Is there a formula that you have on how to go out and raise money? Let's say you have a little bit of money and you want to raise a little bit more money to go bigger.
Yes, yeah, absolutely. The number one thing is don't go public with it.
Okay.
Do your circle A and circle B. You know, people that you know. As soon as you go public, you are now crossing over into the securities area. Not a good place to be unless you have been, the OSC has given you the stamp of approval.
Okay.
Please don't cross that line. But within your world, become an expert, and the more geographic expert you are with that first working capital that you have, get really good using your capital so that when you start to attract other people's capital, you're really good already. Secondly, first off, geographically specialize. And then secondly, know the real estate. Know how to do it. That's why these 97 tips are here, right? Know how to do it so that when you present to your dentist or your uncle, you're not going, this is what I think is going to happen. You can actually sit down and say, here, let me just show you why 3% equals 15.7%. Let me show you how I'm going to mitigate any tenant risk issues. Let me mitigate this. And just show it, because people need to get the return on their money.
And they need some sort of satisfaction of knowing that it is taken care of. I guess the message to take from here is that don't just look out at investing in things. You're investing in yourself first, and then investing in a property afterwards.
You have to invest in yourself first, and you have to know this stuff. You're taking in some cases, you're going to be using a lot of their net worth and you're going to help them build their net worth, but you're responsible for it. If you would not put your own money in that deal, don't put their money in the deal. It's so very important.
I really appreciate you sitting down with me, Don. This is some great information, and your book is 97 Tips for Canadian Real Estate Investors. Anybody that's looking to become an investor in Canada definitely should be checking this one out.
Thank you.
Thank you. I really appreciate it.
Cheers. Thank you.